Hi everyone, it's PJ Patterson here for Market Update. Today is the 6th of May. It's Friday the 6th of May. For those of you that have been following any of my recent Facebook posts, you probably see my screen. There I am right there on Monday night. I'm very, very pleased and happy to share with you guys that this team of young men here that I coach, baseballers, we are the Senior League state champions. So all those kids are under 16. So we're the best senior league team in New South Wales. We're headed off to Geelong next week on Thursday for the national tournament, where the senior league teams from around various states come and participate. There's 8 teams in total, and it was a miracle run for us. We started off pretty poorly, but then started winning ball games, and the kids started hitting, and it was just a fantastic result. So I'm really, really proud of that. That hasn't happened in Manly in this age group for 21 years. So the last time the Senior League Division won a state title was in 2001. So it's been a long time. Anyway, I thought I'd share that with you guys because it's something I'm really pleased about. Now, on to markets, because this is where, of course, you are probably right now going, what in the world is going on out there? What is going on in the world? So I want to try to provide some clarity and some comfort and some confidence about what is going on. Those three things are super important right now because we're getting into the depths and bowels of Quad 4. Quad 4 is nasty. If you could imagine being in a small sailboat in the middle of the ocean, smooth sailing, and all of a sudden a storm comes in that you cannot sail around. The metaphor, of course, is that you need to weather that storm, but of course your boat needs to be able to survive that storm, be a solid boat, a boat that has, the ability to pump out water if it takes any on, this kind of thing. And we're in that position right now, although it doesn't seem like it. We're getting kicked around a lot right now by the ferocity of the ocean. So the top three things today are, first of all, the Fed and rates. I'm going to talk about the Fed as a catalyst. I've used that term in communication with some of you. Maybe I talked about it in my last update. But the Fed, what they're doing, and rates, the economic slowdown that we are now well and truly in, and then finally just hit on a bit of Quad 4. And I'm also going to talk about the usual things, volatility and positions and so forth. But I want you to understand that right now we are in that part of the market cycle where everything is going to look horrible. The only way I could have avoided this would have been, honestly, in looking back, would have been to sit in cash. Now, hindsight is a great thing, and of course, the Monday morning quarterback, as we often call them, armchair quarterback in the U.S., will say, "Well, I should have thrown that pass, or I should have done this, or I should have done that." I don't have the luxury of that. Neither do you. I have to play the game as you do. That's right in front of us, and so again, I'm going to give you some clarity, confidence, and around that. And how we're positioned. So let me just pop open, first of all, talking about Fed and rates. So the Fed this week put rates up 50 basis points. This was widely anticipated. There was really no doubt in anyone's mind that the Fed was going to do that. The bond market had already been planning for rate hikes because the bond market now 30 years up around, hopefully you can see that okay, but it's 314. This is a live feed from CNBC. Is 3.14%. This is up from, actually I'll just go to the 30-year. I can't remember what I said it was back in December, but I'll just pop this on a 1 year. So there you go. Back in December, we were sitting at 1.67 early part of December. And so we've gone up a lot in 5 months, 6 months almost. It's pretty much, well, I guess you could say they've almost doubled. Rates have almost doubled on the 30-year. And across the curve, in fact, we've seen rates rise dramatically. Again, this is because the Fed has been talking about raising interest rates. They're talking about doing, another sort of 8 rate hikes or something like that. Let me tell you, ladies and gentlemen, this is not going to happen. The Fed is already crashing the market. That's what happened last night. We had a massive decline in U.S. indices, having just had a rally. Like somehow, sickeningly, the market rallies because the Fed raises interest rates. It made no sense to me. But in any case, the market doesn't like this at all. And if you rewind sort of months ago, maybe even a month and a half, 2 months ago in market updates, I was saying to you that the Fed's going to precipitate a market crash by doing this, and that's exactly what they're doing. To date, the Russell and the Nasdaq are down roughly 20%. I think the Russell's down about 18. The Nasdaq's down somewhere around 20 or 21, something in that range at this point in time. But the Fed is again making a policy mistake by tightening into an economic slowdown. This is the stupidity of central planners, and in particular, these guys at the Fed, is their models don't seem to be particularly good at predicting economic activity. Now, they're saying that they're concerned about inflation. So I don't know, it's probably not on any of the headlines here, but one of the things that they are most concerned about is inflation. Now, inflation is being broadly driven by the oil price. Again, been talking about this for a while now, and at some point, oil is going to have a demand shock. So because the economy is doing so poorly, and I guess I'll move on to point number 2 now because I seem to be talking a little bit more now about economic stuff. Because we've had an elevated oil price for so long, that's sucked money out of the economy. It costs more to fill up your car with petrol. Natural gas prices have been elevated. Diesel, all the other fuel components, stuff that gets produced from a barrel of oil for the fuel markets. All of that stuff has been elevated in price. The net effect of that is, of course, less in your pocket to spend on other stuff. In fact, the U.S. consumer has probably never, ever been in worse shape. So it's only going to get worse in terms of the U.S. consumer and the U.S. economic data. But inflation data has kind of been persistently elevated, but should have peaked in the last quarter. So I fully anticipate that we're going to continue to see oil come off of its highs, and as a result of that, the inflation numbers should relax a little bit. We'll still be at elevated levels of inflation, but all of this is going to continue to cause an economic slowdown. Now, that's going to happen in the U.S. It's already happened in China. It's happening in Australia right now, where we thought we might go into Quad 1 this quarter. I was about to start buying some Australian equities recently, but they went up to a level that they weren't able to hold, and therefore I'm not allocating any capital to anything in Australia right at this point in time. In fact, I'm not allocating really any capital to anything other than bond positions, and I'll cover that in a moment when I talk about Quad 4. But let me just see if I can grab a couple of tables. So this is, let's see if I can make this larger so you can see it. One of the markets that obviously is greatly affected by interest rates increases is housing. And what we've seen is a precipitous decline in mortgage purchase applications since, I think that's since February or so of this year, where they had sort of peaked. And this is bad. So what this tells you is that the housing economy in the U.S. is declining rapidly. This is week over week. And then on a monthly basis as well, we've seen steady decline. So this, again, is not a sign of a healthy economy where mortgage applications and purchase applications are in decline. Refi applications, same deal. They're dropping precipitously because, of course, rates are rising. Now, I have no reason to suspect that this isn't happening in Australia. We just don't have a lot of granularity on this mortgage data in Australia. But this, of course, would be going on here. And I can tell you as a person that owns a mortgage brokerage, I've seen rates now effectively skyrocket on fixed rates. 3, 4, 5-year fixed rates are now all pretty much with a 3 or 4 in front of them. The variable rates are going to start to move up. So again, this is going to cause pain even in the Australian economy because people are going to have to pay more for their mortgages. They're not paying more for fuel. They're going to have less to spend on consuming. So that's a big issue. Pardon me. Now there was something. Oh yes. So another couple of metrics for the economy are the ISM numbers. So the services, we've hit an all-time high in the ISM new orders. We're headed down towards this contraction line here, which is 50. Will we bust through that in the next couple of months? Probably. I mean, if the Fed raises rates another 50 basis points, this thing will probably slice through that like a hot knife through butter. Prices paid. This ISM is International Supply Managers. And so we've seen an increase in what they have to pay for for their input costs. And this again, this is a serious issue. And I think there was no, I didn't have another chart. There was one other thing I wanted to show you, and that is, oh, and we'll come back to that in a second. Um, which is this. This is industrial metals like iron ore, zinc, aluminum, and copper is in the same boat. We've started to see the industrial metals declining. So again, this is where we're starting to see deflation coming into the economic picture because things like copper, things like iron ore, zinc, and aluminum, or aluminium, as it should be said, of course, the way we say it in Australia, prices are starting to drop fairly rapidly. Now, that's not the sign of a growing or strengthening economy. It's the sign of a declining and struggling economy. So that I just thought I'd call that out. Now, just to sort of pivot back towards rates and quad 4. Quad 4 conditions are those where growth is in decline. Typically, interest rates are falling, not rising. Okay, so I'm going to talk about that in a second. And inflation is falling. We're not necessarily in a deflationary environment, which is very difficult to get into. It'd be more disinflation, where you just see the rate of inflation falling. So we're going to be in a disinflationary environment more so than outright deflation. But what's happened here, and what this chart is really showing, is that we've crept up here to a period where we're getting close to where we were back in 2019, where again the Fed had made sort of a policy mistake leading into 20, well, it was throughout 2019, and started to reduce. This was in 2018. They had put rates up into, I think it was Christmas and January, Feb, and then they had to, through the course of that year, start to discount rates. And look at where rates went. Well, they went to, over the course of another sort of year, it took rates to go back down into that 1% range. So what this is kind of questioning here is we're getting close to that high water mark. And I know a few of you have contacted me recently and just you're wondering what's going on in the markets. Well, this is what's going on. Is at some point, this U.S. 30-year and a lot of other U.S. rates are going to start their descent. They have ascended, they're going to start their descent. And that's going to play out over a longer period of time, probably 6 to 12 months, longer than I had originally thought that it might this year. So at some point, I do not know when this is going to happen, but at some point, the Fed has already begun the policy mistake. All right, the policy mistake is raising interest rates into a slowdown. And so at some point, they're going to have to call no mas and say, okay, well, the economy is in a bad state. Labor market figures, which we get some labor market figures tomorrow, and then there's some others that come out over the course of the next month. That's going to be a big indicator for the Fed of what they need to do in terms of policy. But they're going to have to begin some form of quantitative easing, bond repurchase program, something to reduce the level of interest rates. And once that starts to happen, all the bond positions, which are quad 4, you want to own bonds, they're going to start to perform and effectively, back to the boat analogy, be that bilge pump for getting water off the boat. But right now we're getting to that point. Again, I don't know when everything's going to break massively, but I'd be keeping an eye right now on how the markets are trading. And one of the things, of course, that we watch is volatility. So I just want to go into a couple of the metrics that we typically cover during these market updates. Volatility is in the bad bucket, which is 30 plus vol. And over the last couple of trading days, it's been unable to sort of stay out of that bucket. It's hovered around the 30 mark, as you can see here on this chart. We had a little bit of a dip down. Again, why volatility was suppressed, and this is a bit more of a market stuff that goes on in the market. Volatility was being suppressed by options dealers who were basically looking to get a number of highly liquid and highly with a lot of volume and a lot of open interest. That's what the term I was looking for, to expire sort of worthless. And so there was a bit of market trickery going on around this suppression of vol here over the last 2 days, and then all of a sudden, bam, it just explodes again. Could this vol go up into the high 30s and 40s in a New York minute? It could. That's going to cause more problems in the market. So I think the biggest thing that I can say right now to you going forward is the strategy is to have the quad 4 portfolio on. And at some point, as I said, the Fed's going to have to call timeout on rate increases. And the moment that happens, rates are going to start to come down. And they'll probably fall fairly quickly because the Fed will begin using language that, they're going to support the economy, support the stock market, blah, blah, blah. And you're going to see that begin to happen. And I think it will happen over a longer tail duration, probably 6 months or so. So that interest rates get back to a level that are supportive of economic activity where we can begin growing the economy again. So that will be supportive for things like gold, which has been a relatively good trade at this point. Less volatility, not down as much as other things, but gold doesn't like when interest rates go up. But gold hasn't really, as an example, gold hasn't really look too bad if the chart comes up over the last, I don't know, 3-4 months or so. It's gone up to 2050, but its decline has been fairly muted despite raising interest rates. So the gold market knows that something is going on here. It's one of those markets that you watch to see what we might anticipate into the future. What else can I quickly talk about? Yes. Well, let's talk about Russell and NASDAQ vol. So Russell vol has been elevated and continues to rise. This is the small cap index, so the Russell 2000, which is a lot of small cap companies. It's been getting absolutely smashed in the last couple of months. The NASDAQ, similarly, vol is elevated, high and elevated. Pardon me, could continue into the 40s. If it does that, again, a lot of these tech names that a lot of people own. So, all the big ones like your Microsofts, your Apple, Amazon, Facebook, Google, all those companies, Tesla, Netflix, they're going to get crushed in terms of this part of the market cycle. So really, the only place to hide out right now is gold, cash, bonds, and bonds of longer duration, and some select equities like utilities, some of the components of the S&P 500 that are more defensive in nature. So utilities, food and beverage, consumer staples, that sort of thing. But the equity component I've stayed away from, except for having a position in the utilities, simply because they're going to go down with the rest of the market. Housing would be the other one. So things that are interest rate sensitive. Once interest rates begin to fall, all of the interest rate sensitive investments are going to perform well. The other thing to bear in mind here is that I'll be looking for an opportunity, and we're going to get one. If the market crashes 35-40%, that's a buying opportunity for particularly things like small caps and some of these more value-oriented stocks. Now, that's going to be more of a timing. It's going to be interesting to see how the timing of that might play out. But at this stage, we're looking like we will be in quad 4 for the rest of this year. That's both in Australia and in the U.S. This is pretty unprecedented times around that. So it's the only thing I can say is it's time to just batten down the hatches, to sit tight, do nothing, have the quad 4 portfolio on, and just accept that we're going to be in some rough seas for a little while. And that's all I really have to say today. If anything changes on that, I will certainly let you know. I'm playing around the edges a little bit with some of the positions we have on that are going to get probably even cheaper. So things like Restoration Hardware and Playboy, they've been absolutely hammered because they're more or less small cap stocks, and small caps don't like quad 4. But the time to buy good companies is when they're deeply discounted. So if there's any final word or thing that I can say in terms of this market update, is that, and this is something I try to do, I do not look at this at all from an emotional level. I have my money invested the same as you guys, and right now I'm getting beat up around the interest rate trade as much as everyone else. But I also recognize that out of these moments of market volatility come opportunities. So one of the things that I want to remind you of is that yes, we're trying to play this game in shorter periods of time to get things right. It doesn't always work out that way, but we're also looking at this over a longer term time horizon to make money over the long term. So what I would suggest you do if you are concerned or frustrated or any of the above around what's going on in the markets is to pull back and look at this over a much longer period of time. Um, and I can assure you, I am trying every single day to get better and better at the decisions, the timing decisions, and everything else around portfolios. I'm not perfect, clearly, and so what I would ask you to do is be patient. That's one of the best things you can do in markets is to simply be patient and don't get emotional about stuff. That's probably enough for me today. Have a wonderful weekend, everyone. Please, if you have any questions about anything, let me know. We shall see what the language is coming out of the Fed over the next course of the next couple of weeks. If they start to blink, the market will certainly send us a signal, and we'll take it from there. If there's anything that happens that requires a flash update, I'll certainly do that. Next week for me is going to be a little bit discombobulated because I will be traveling on Thursday down to Geelong. I'll see if I can do a market update on the Wednesday. I think I've got a a mid-quarter economic update coming through from Hedgeye. So if there's any real pearlers insights out of any of that, I'll certainly share those with you. And for now, that is it. Have a fantastic weekend, and I'll see you on the next update. Thank you.